Welcome to our Savvy series. I'm Catherine Magana here with Rachel Ivanovich. And today we're going to talk about tax-related mistakes when receiving an inheritance. So we're going to continue the conversation, but more on the tax side of it. So let's dig in. Kind of one of the items that comes up is failing to account for estate and inheritance taxes. So
you'd have to inherit a lot of money.
True, that is true. And
at least right now.
Yes, I think the limit was in 2024.
$12.92 million per individual.
And then there's talks, obviously, for the sunset, which, so that could change.
At the end of 25.
Yeah, so there's rules and things, and we're not saying do anything just yet, but that's something that will change, obviously, depending on, what happens.
I think it's really important for people to consider it because the Tax Cuts and Jobs Act, as you were saying, you alluded to the sunset, and what you're talking about is the Tax Cuts and Jobs Act did raise the lifetime exclusion amount significantly for a lot of individuals. It therefore will not be paying estate or inheritance taxes, but at the end of 25,
it goes back plus a little bit of inflation, right?
Correct.
But if they don't make any changes,
somewhere around $7 million, maybe. We'll give or take a few millions. Yeah. But I think that people should definitely be you should be planning for this and thinking about this. If you're in the $5 million range, definitely need to be thinking about that.
And then another one is not understanding capital gains on inherited assets. So when you have inherited assets, it could be stocks, bonds, real estate. There's a lot of kind of different types of investments that you have to consider.
I have a lot of clients that call into the office and they're in a panic because they just inherited somebody. The parent passed away and our uncle passed away, and the question is, how much tax am I going to owe on this? And of course, they want to use the money or the property that they inherited, but they definitely want to plan ahead for the taxes. And the good news for most people is when you inherit property or stocks, but investment assets, you get what's called a step up in basis. And what that means is, let's just say your parent or whoever left you the asset, they bought it for $10 and now it's worth $1,000. If you turn around and sell it for $1,000, you're not going to be paying on the difference between $10 and $1,000. You actually get the fair market value on the date of their passing. Yeah. So it's a huge tax advantage as long as those assets aren't in an irrevocable trust. And therefore, there's conversations to be had while people are still alive, because I've had clients make the mistake of putting assets in an irrevocable trust, and then all of a sudden they lose that step up in basis.
Ouch.
And it can be significant. It could be good for estate planning. So everybody's situation is different. Yeah.
Well, we had a call a couple weeks ago that came in, and they said my sister's father-in-law wants to sell their house and take the gain and then distribute the assets, but then you have to look at...
We're like, time out, don't do that right now.
Because then later they could have that
tax benefit.
So you really have to look at the numbers. And the idea is, yes, I want to give you your inheritance now, but the reality is, does that really make sense?
You're going to end up paying $400,000 in taxes versus zero.
Exactly. So then you mentioned step up. Another thing that comes up occasionally is the alternative step up, which means there's an alternative valuation done, which is 6 months after date of death. So
That's
kind
correct.
Of between those two is something that can get looked at and considered as well.
And it definitely is an individual situation. So you have to look at each situation individually versus just a blanket rule across the board, kind of like everything. But.
Exactly. And then if you do get the step up and then potentially you want to sell, say, those investments, and there's gains, those gains could be taxed at ordinary income if it's less than a year after that step up. So there's a lot of little nuances you got to be careful.
We had a client who came in just a couple of days ago who she and her husband owned the house. And they had lived in the house as their primary residence for the past, 40 years, let's just say. And she's in her 70s, and he passed away. She was really worried because she was going to sell this house for, almost $2 million. And they had purchased the house for $40,000 whenever, back in the 70s. And so now she's thinking, what am I going to do? $1 million in taxes now that I'm selling this house. And so the good news was, met with an advisor, talked with me, and she's not going to pay really anything at all because he passed away, and they got a valuation done on the property. Realtor pulled comps. The house was worth, $1.6 million when her husband passed away. And in the state of California, which is a community property state, you're eligible for a full step up in basis. In separate property states, the laws are different, and so what happens is each spouse is deemed to own half of that property, and so you retain, if you're still the surviving spouse, you keep half of the basis, and then the other half, the spouse who passes away, their half steps up to whatever fair market value is. But again, she was in California and therefore received the full step up in basis. So was able to say, okay, I paid, my adjusted basis is 1.6 million. I'm selling for 2. I had improvements of, $300,000, and you're still eligible for the IRS Section 121 exclusion, which is the $250,000. So you do the math, and all of a sudden, there's zero capital gains on that. So she's able to ride off into the sunset with our money. Is really happy.
So once again, from planning and kind of tax planning and making sure, okay, what's the best situation, and then, obviously long term. A lot of times, what we find is there's a lot of equity in those homes, and so what's a good strategy overall?
Correct, and honestly, it really worked out for her because she was able to take the cash from the proceeds of the sale, and we'll be able to buy another house, and we'll have money to invest.
Yeah.
So definitely it makes sense to work with an advisor and find out, how does your individual situation apply?
So another area would be overlooking required minimum distributions for inherited IRAs.
This is a hot one.
I know.
It's a messy one.
I know. So it's a little convoluted, but prior to the Secure Act of 2.0, so before
2020,
spouses are a little different because spouses can.
Well, the good news is surviving spouses they retain the ability to treat the IRA as their own or not.
It used to be if you were non-spouse or non-designated beneficiary that you could then stretch that out over your life expectancy potentially, and so that would mean you just take a little bit of money out each year. So if you fast forward now, as of the new rule, the Secure Act of 2.0. If you receive an inherited IRA and you're not a non-spouse, then after January 1st of 2020, there's new rules. And so you have to then at that point, potentially, depending on what type of beneficiary you are, take money out over 10 years. But then there was really no guidance on the required minimum distributions. So
it's been really messy the last 4 years.
So then now it's if you
Well, they're throwing out terms like EDBs and NEDBs, and what does that even mean? And why did they do this? Yeah. And so the thinking at least in the tax community is that IRAs were meant to be retirement tools for the individual that was investing in them. They weren't supposed to be legacy tools. And so therefore, I think Congress was looking at it, okay, well, if you're not leaving it to your spouse and you're leaving it to, let's say your kids, and they're stretching it over their lifetime, that's not what the original intention of the IRA. And so therefore, now they've come up with EDBs, which are eligible designated beneficiaries, and NEDBs, which are non-designated beneficiaries.
And the eligible designated beneficiaries are surviving spouses, disabled persons, chronically ill persons. We have minor children.
Which is an interesting definition in and of itself.
And so, and a little more detail, which it's kind of case by case, but with a minor child, I guess it's age 21.
Or
under. And then if there is a minor...
It doesn't matter what your state says.
Yeah, and if they're under 21, then they have to take out the stretch, or they have to take some money out. And then once they reach 21, then the 10-year rule comes into place, but then you still have to take a little bit of money out. So there's a lot of nuances.
It's really complicated.
Yeah, and they keep kind of coming out with new guidance. And so it's been interesting to try and navigate. Bottom line is, starting in 2025, for inherited IRAs that were after January 1st of 2020, that those required minimum distributions need to start coming out.
I honestly think if you inherited an IRA, you need to call your advisor.
Exactly.
Because as advisors, these rules are very complicated even for us. And I think there's even some other subcategories of, was the person who left you the IRA, were they already taking their RMDs or required minimum distributions, or were they not of that age, the required beginning age or whatever? It's so specific to the situation. For instance, I had a client who recently inherited her dad's IRA, and so she's a non-eligible, she's a designated beneficiary, but she called me. She's like, okay, do I have to take the money out over my lifetime? Do I have to take the money out
10 years?
Over 10 years? Do I have to take it every single year of the 10 years? Do I just have to empty the account by the end of the 10 years? And the rules really, like you were saying, were really unclear until July of this year. Yeah. And so, for instance, the final guidance came out in July. And so in her situation, so she would be a non-eligible designated beneficiary. She inherited the IRA from her father in 21. And her dad's age when he passed away was 80 years old. Okay, and so that's that little other factoid that you have to know. Like, was he already taking his RMDs or was he not already taking the RMDs? So for her situation, she was subject to both the 10-year rule and the annual stretch style distributions, which you're just like, what does that even mean? and then she's like, but wait, I haven't taken any of the distributions from the inherited IRA and it's 2024 and am I in trouble and what am I supposed to do? And so thankfully there is IRS relief from the required minimum distributions through the end of 2024. So if you have inherited an IRA the last 3 years, don't panic.
Yeah, they gave some leeway because everything's changed. Everything was changing.
There's 3 different notices that the IRS has released, 2022-53, 54, and 35. So basically, there's no penalty for failing to take your RMDs the last 3 years. But in terms of future compliance, beginning in 25, you have to start taking those annual stretch style RMDs if you inherited from a parent, let's just say, and they're over the required minimum distribution age.
So another thing that comes up as we're looking at taking distributions from inherited IRAs is we do a lot of financial retirement tax planning, and some of the things that come up occasionally are partial Roth IRA conversions.
There's a lot of those
we do.
Right now.
And so when we look at that, if there is an inherited IRA, that's income. That's income that gets taxed. So that also has to be looked at. And then once again, with these rules that have changed, for a short period of time, you can make some decisions if you want to take it this year or not. But starting next year, as we look at the Roth conversions again, you definitely have to add that in.
Sense.
So that's something you have to, kind of look at big picture. It's not just, hey, when am I going to take money out, or how am I going to take it out over 10 years, or what that looks like. Yes, you want to abide by the rules, but you also have to look at, are there some other planning that we're looking at along the way? So then once again, because there's some tax consequences with that. Always tax consequences.
I know. It's a lot, Catherine. I don't know. They keep changing the rules.
So then there's mismanaging inherited IRAs and maybe choosing the wrong distribution. So you do have a lot of different options with taking money out depending on what kind of beneficiary you are. One of the things that you do want to make sure that you look at is if you're taking a lump sum, that once again, does that make most sense for you? Because, depending on the amount, that does get added onto your taxable income. So, once again, there's kind of a little bit of planning and a lot of moving parts when it comes to inherited IRAs and
there's also something weird that I thought I should still bring up so typically when people pass away, a lot of the tax consequences are negated, but not for IRAs. Correct. So let's just say, for instance, you have a parent that are already taking their IRA distributions annually and they pass away mid-year and they haven't already taken that required minimum distribution, or maybe they've taken a portion of it. You as the beneficiary still have to take the difference for that year. And a lot of people don't know that. They think, oh, well, they've passed away. They don't have to. That doesn't apply to me anymore. So make sure that you are getting informed on that.
And then we didn't even go into Roth IRAs, but that's a whole nother
podcast.
That's a whole nother podcast. But I think that concludes today's discussion, and we'll continue the discussion on inheritances. And thanks for joining us today. If you need specific help or want to talk to us specifically, we'd love to set up an initial consultation with you. You can reach us at 760-692-5700. And thank you for joining us today. And remember, savvy up. Please stay tuned for important regulatory disclosures.
Savvy Women Wealth Management is an SEC registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.